Good morning, everyone. Today is the 16th of March. This is Brad Matheny. I'm coming to you with an update after I just got the new real estate market data off of Realtor.com. I'm coming to you to tell you that I believe the Fed will be pushed to move to a more dovish stance, possibly pausing, possibly reducing rates while opening up extended lines of credit related to extreme risks in the global financial market and real estate hard asset market. My belief is the downside move that we're seeing, the real disruption is starting to take place right now in the real estate market, and it could shift the way the markets work going forward. This is not 2008, and I'll try to explain why. Number one, a lot of people are already anchored into extremely low interest rates, meaning if they have a job and the economy is still performing, they're able to make their $1,500, $2,000 a month or less mortgage payment and continue to survive without too much difficulty. What's happened is the Fed has raised rates aggressively over the past 13, 14 months, maybe a little bit longer, and this has created a real crisis for foreign governments, foreign central banks, foreign corporations, and even U.S. governments and corporations. The Fed moving to a more accommodative stance will likely attract a large block of capital into U.S. assets, while meaning stocks and commodities and ETFs, potentially more so stocks and technology and healthcare, biotech, things of this nature. But we have to be aware of the fact that asset prices will still need to devalue. So the Fed could move into a weakening stance, possibly pausing, possibly dropping rates by a quarter or so. My research says the Fed is already close to double the upper threshold on the Fed funds rate to not disrupt the economy. My upper threshold is around 2.25% Fed's fund rate. And now we're above that. So any weakening at this point could be interpreted as a Fed pivot, could be interpreted as unending QE support for the financial system, US and globally, while the Fed tries to move to a more neutral stance, which may end up being 2.75, 3 and a quarter, possibly, which could still push an unraveling of the real estate market. Now, let's have a little fun over here. Take a look at this data, which is my custom real estate cycles index. I call this the hostility chart. We have essentially the hostility measurement here, the highest, most hostile level we've seen in 25 plus years. You can see we got to a point of extreme hostility here prior to 2020. This was the end of 2019, beginning of 2020. This is COVID, where everything became super, let's call it appreciative, meaning least hostile, very friendly market environment for buyers to get in. You can see the 2008 peak back over here. We had this rollover and then another peak, and then we devalued back down into these lower channels. Pay attention that everything we've had has been pretty much rolling into this lower blue channel, except for this COVID crisis, which was the global shutdown. We may be about to repeat some of this for the real estate market, commercial and residential, meaning we could see a move back down into this 200, 180, maybe 170 level, which would likely see prices move down below this 300 level, putting us in a 240, 260, 270 area. It could be, quite extensive. Now, remember, we didn't see a big decline here as we saw this market move down because the Fed went back to zero. I don't believe the Fed's going back to zero right now, folks. Feds are going to end up probably in the 1.5 to 2.5 range, trying to keep the wheels on a train to avoid inflationary pressure. But we could see asset prices continue to flag out, move downward, move sideways, possibly down into this 300, 270 area like we saw after 2008. It could very well happen. Now, let's come back over to the data. The actual data itself is very interesting. We do not see a big decline in price trends yet. We do not see a big, we are seeing basically a huge increase in price reduction activity. Price reduction activity is skyrocketed here to 150%. Okay, active listings are diminishing, although active listing count here is at the highest level we've seen in quite some time. So we've got 61% active listings. This means we have basically, if I do the math right, about 11 to 14 months worth of inventory on the market right now, and growing simply because days on market is extending higher. But what's really interesting here is, let me try to come to the next chart, is, well, here's the master page of all the data. So understand here, here's reductions up in the 125 area. This is 1.25, so think of it as 125%. Here is active listing count is positive but weakening. Here's days on market starting to move back higher again. Here's price, median listing price level has come down quite a bit. This is year over year. So we were up in the, say, 0.4, 0.5, actually 0.2 area. And now we've come back down to almost flatline. And then price reduction share, which is this lighter number, is actually getting taller and taller. This is going to end up skyrocketing higher. It's going to be hard to see on this chart. But here's my modeled market demand and pricing factor. Pricing factor is still in negative 20. You can see it right here, negative 17.44. Model market demand is 30.58. This is telling you that the demand has moved higher. Now, as I mentioned to you before, this does not go back too far. This goes back essentially 1 year. Maybe I'll increase it out for you, but this is a reversion. Model market demand was up in the 140, 150 area prior to this. We ended up down here in the minus 40 area. So modeling back to a reversion flatline area between this plus 140 and minus 40 would essentially put us in the 40 to 50 area in theory on this chart. We're at 30.58. I believe we are just flatlining in a weakening trend, meaning that we are seeing demand destruction because of interest rates, and we are essentially flatlining before something ominous happens. Now, if I move over here, that's not the right one. Oh, now I got to go find it. Okay, hold on, guys. What happens is these things move in different order. Here we go. Okay, here's the fun one. The heat rank is now at a flatline area. Okay, this is showing weakening heatness in the market or hotness in the market. We're now at kind of a flatline area. This is updated as of March 11th, just last week. So understand that this is still negative, still downward. We haven't seen this kind of downward pressure in quite a while, but price has not moved down aggressively. The tightness ranking here is negative, strongly negative. We just bounced off of this number, which is fine, but we have now in the deepest negative territory that we've seen. We were at minus 100% just a few weeks ago. Real estate inventory strength, just like I predicted, is moving downward. This is essentially the strength of inventory in pricing and activity concerns. So think of it as if you have a strong market, price will go up, like you saw back over here. Inventory pricing strength will go up. If you have a weaker market, price will go down. Inventory strength will go down. That means you're holding on to something that is losing value, not gaining value. Okay, when it moves up a little bit, this is kind of like a reversion after losing some value. It might move back up a little bit, kind of move into a flatline area. Now we're into a deepening area. But this is the real news this week. Seller desperation index is up to 385%. Now, again, this is modeled based on the data, but this is telling you that sellers are getting desperate. They are getting desperate to move inventory. And when they get desperate and a weakening market trend, weakening inventory trend, and price reduction trend, what ends up happening is you start to see very large price declines happening. And my assumption is that as long as the Fed does not drop rates below, say, 3.5 to 3, that this unwinding of the real estate market will continue. Okay, it may be something that is isolated to certain sectors of the real estate market, maybe commercial, maybe at-risk residential real estate areas, but understand that we are likely to see some sort of an event take place over the next 3 to 6 months. It's very unlikely that the Fed is going to drop rates, the Fed funds rate below, say, 2.5 to 3.5 from these levels right now, simply because they're still battling inflation. This type of a downward event in real estate would act as a deflationary trend, but it would also act to attract global market assets. So, for example, as the housing market contracted, and this was really the banking industry contraction in 2008, 2009, once the risk of the banking industry dissipated, remember, the housing market continued to decrease. In fact, let's come back over here. Take a look. The housing market decreased from 2007, 8, 9 all the way down to about 2013, 14 before it started to appreciate. So when we come back over here and look at the U.S. valuations trend index, remember that the stock market revalued all the way back up to here, possibly even a bit further, until 2013, 14 before the real appreciation phases took place. So we could see the U.S. stock market revalue through the end of this year and into 2024 before the housing market finds a bottom. And what that means is that people are avoiding real estate as a declining asset level or value and moving into something that is likely to perform better, which is a reflating stock market, potentially reflating stock market with the safety of the U.S. dollar, with the Fed essentially acting as a backstop for the global banking industry. So pay attention. This is not something you want to play around with. The real risk here comes from the fact that we have these numbers right here. Tightness is at a negative 50, 60%, negative minus 39, sorry. So that's the tightness index as far as where it's at. It moved up. This is last week. Moved up 39 points. We're still at minus 55. Inventory strength moved lower. Okay, this means that inventory is weakening in true value. Okay, seller desperation has skyrocketed. If we see this level stay up here, which I do not believe will happen, this might be a blip. This might be a real indication that sellers are moving away from trying to hold price levels. We might see a slew of new inventory coming in with price reductions, big price reductions. But understand that if we start to see a lot of numbers up in this plus 100, plus 200 area, this means we're moving into a very strong price declining mode. With the tightness rank being so low, the inventory strength being so low, and seller desperation peaking, what would happen is we would see the heat rank move back down into minus 5, minus 10, maybe minus 15 area. And that tells us that we're starting to get some real serious price declines throughout the market. And that's going to tell us that the real estate market globally has started to fall apart. That could again mean that the U.S. stock market index could get shaken out over the next 3, 4, 5 months, likely to stay moderately sideways as we see how this plays out. And the Fed now has new problems on its hands. That is a broadly weakening real estate and global real estate market, which could again affect the banks. The Fed has moved rates too far, as we're all aware, and the lagging effect of the economy is now starting to bite. At this point, as it bites, you're going to see a flight to safety. Gold, silver, platinum, precious metals, strong assets, technology, healthcare, biotech. I can think of a few others. Maybe defense firms. Trying to think of a few. Maybe essential blue chip types of firms. When I call them blue chip, we're talking about large cap firms that'll, even though they may take a hit in earnings, they will still perform and still perform with dividends. You may see some real strength moving to the larger, more sustainable companies. We could see a big decline in at-risk companies, kind of like a dot-com bubble burst. I hate to use the example, but VC firms that aren't making any money, that are having trouble, we could see a lot of risk factors involved in these sectors. So be aware. We could see a very big decline taking place, and some of the biggest, baddest, large caps and specific sectors are likely to perform very, very well over the next 18 to 24 months. All right, guys, pay attention. Follow my research. Visit MENT.com. Sign up for the Expert Growth membership. I'm going to take all of this research private very quickly. The only reason I haven't done it yet is because my SPY cycle patterns are still available free for everyone. And I want to try to show everyone what they can do and how it works and how my research works. Ideally, I work for you. You join my Expert Growth member subscription. You're paying me a small monthly fee, and I can sit here and continue to do my research and provide you with this data so you can be aware of it and protect yourself properly. REITs will likely have some real valuation problems over the next 6 to 18 months, if not longer. Pay attention, guys. Here we go.